Hey everyone, and welcome back. Get ready because a massive announcement is here today that's going to shock the world. And if you think what's happening today is big, just wait until you see what's heading our way over the next few months. Right now, all eyes are on the labor market, and everyone's asking, what kind of jobs report will it take for the Federal Reserve to cut key interest rates by a full half percentage point? Today, the big jobs report is out, and it's going to give us a clear picture of the U.S. economy, especially the job market. This is absolutely huge. It could show that certain policies are working, that the Fed is on track with its monetary decisions, and that you, the American consumer, might see bigger paychecks and more confidence in the future. But here's the tough truth. I think what's coming today will disappoint a lot of people. And what follows in the next several months, that's going to be downright terrifying. So, what does it truly take for the Fed to cut rates by a full half percentage point? Experts suggest we'd need to see fewer than 40,000 new jobs added, and the unemployment rate would need to be at about 4.4% or even higher. Honestly, neither of those numbers seems very likely right now. Many investors are cheering for a big rate cut, thinking it will send stocks soaring higher. But here's the kicker, and it's a crucial point. When the Fed starts a major cutting cycle for interest rates, it usually signals that the economy is starting to fall apart. We've seen this pattern repeat itself many times throughout history, signaling deep trouble ahead, not a booming market. The official unemployment rate looks incredibly steady, hovering around about 4% for over a year. But this number is deeply misleading. The real problem is that the percentage of working-age people actually working has been steadily dropping over this period. This means people are leaving the workforce. They're giving up. They feel like there are no opportunities out there, so why even bother looking? What this translates to is that while the headline unemployment rate might not jump much, the true picture of job creation is far, far weaker than officially reported. Some estimates suggest that net job creation from new companies is actually only about 20,000 a month, not the government estimate of around 90,000. So many of the job reports we're seeing might be significantly overstated. And here's another major red flag waving brightly. A top job tracking firm just announced that U.S. hiring intentions have plummeted, while job cut announcements are on the definite rise. This past August, companies plan to add only about 1,500 jobs across the country. That's the lowest number for that specific month since all the way back in 2009. And retail companies announced almost 86,000 job cuts, which marks the largest August total since 2020, if you exclude the massive impact of the pandemic. This number is the highest for any August since the major financial crisis of 2008. This is a very clear and undeniable sign of a big imbalance in the job market, something we usually only see when the economy is already in deep, deep trouble. When companies start announcing planned layoffs, even if those layoffs haven't physically happened yet, it absolutely rattles everyone. If you work at a company that just announced it's cutting about 10% of its staff, you immediately start to worry if you're next. And what do worried people do? They drastically cut their spending. That's precisely what the U.S. economy does not need right now. A recent survey from a big consulting firm showed that holiday spending plans are expected to drop significantly. When consumers pull back, that means confidence drops, and retail sales figures go right down with it, creating a dangerous downward spiral across the supply chain. Even other recent reports show we're on a very troubling path. One report showed U.S. firms added about 54,000 fewer jobs than expected. While the market sometimes dismissed this particular report, it's another significant sign. Also, wage growth, which has been a bright spot for some, is about to slow down big time. While people who switched jobs saw about a 7% pay bump and those who stayed put saw about a 4% gain, all signs point to these gains dropping off soon and in a major way. This means less money in your pocket and less money circulating in the economy. We're also seeing initial jobless claims tick higher, reaching their highest level since June. While about 230,000 claims is still low historically, the real danger everyone needs to watch is continued claims, which are currently at about 1.9 million. If that number crosses 2 million, it's game over for the US economy. Historically, rising continued claims strongly signal that initial claims are about to surge, meaning many more people losing their jobs in the near future. The fact that continued claims are not dropping is a huge problem. Even the services sector, which seemed like a bright spot for a while, is showing significant cracks. While overall activity expanded recently, the employment part of this key report has actually contracted for the third month in a row. This means companies are not expanding staff, they might even be cutting hours, which very often leads directly to job losses. Business order backlogs, which kept many people employed, have dropped to their lowest level since 2009. This means when those backlogs are finally gone and the current work runs out, we're not just looking at a few firings, but a whole lot of them across the economy. So, when the big jobs report comes out today, don't just look at the headline number. That can be very misleading. The most important thing to watch is average weekly hours worked. If those start to drop, even if the headline jobs number looks okay, it's a clear and undeniable signal that we're heading straight into a labor market recession. This entire situation is going to come unglued over the next couple of months. The bond market is already signaling that a 0.25% interest rate cut is likely coming from the Fed. But don't be fooled by small cuts. What's unfolding in the next few months isn't good news for stocks, for any political policies, or your wallet. It means we've reached a critical tipping point, and we are facing a labor market recession. When that happens, it's almost guaranteed we're headed for a massive financial crisis. But even if that happens, it doesn't mean you have to lose money. Being informed and prepared is absolutely key to navigating these challenging times. That's all for today. If you found this information helpful and valuable, please hit that like button, subscribe to the channel for more crucial insights, and don't forget to ring the notification bell so you never miss an important update. Thanks for watching, and I'll see you next time.